The most powerful man in Washington just took total control of the Federal Reserve, and the very first thing that happened was your mortgage got more expensive, not cheaper, more. For a year, everyone watched the wrong fight, who Trump would pick to run the Fed, who'd get fired, and almost none of it mattered, because the Fed chair doesn't set the rate that actually runs your life. In the next few minutes, I'll show you who really decides what your mortgage costs, what the government pays on its debt, and why the man who spent a year fighting to win the Fed just lost, badly, to something no president can appoint, fire, or threaten. It's all on the record, the Fed's own filings, the Treasury's own yields, and the vote from the Fed's July meeting. Because Trump got exactly the Fed chair he wanted, and the day it happened, the rates that matter went up, not down. Here's the setup, fast, because you lived through it. All of 2026, President Trump waged open war on the Federal Reserve and its chairman, Jerome Powell. He called him too late Powell. He called him a dummy, and he was crystal clear about what he wanted: cut interest rates. Not a little. Trump said the benchmark rate should be slashed to 1% or lower. It was sitting near 3 3/4. Why does a president care so much about rates? Because the government is drowning in debt, and lower rates make that debt cheaper. We'll get to exactly how much in a minute. The number is worse than you think. And then Trump got his win. Powell's term as chair ended, and in May 2026, Trump's own pick, a former Fed governor named Kevin Warsh, was sworn in as the new chairman of the Federal Reserve. Game over, right? The president's guy now runs the Fed. Cheap money is coming. Except that's not what happened. Not even close. And the reason why is the whole point of this video, because it reveals who actually holds the wheel. Let me show you the two walls Trump ran into. The first was inside the Fed. The second, the one that really matters, was outside it, in a place no president can touch. Wall 1. Even his own chair wouldn't do it. Warsh takes over. His first big meeting as chairman is at the end of July 2026. Everyone's watching for the cut. And the Fed holds. Rates stay right where they were, 3.5 to 3 3/4%. Now here's the part nobody expected. The vote to hold was 9 to 3. There were 3 dissenters, 3 officials who disagreed, but they didn't want to cut. They wanted to hike, to raise rates, because inflation was still running above the Fed's target. Sit with that. The president demanded 1%. His hand-picked chairman held, and the only disagreement in the room was from people who wanted rates to go higher. Trump won the chair and still couldn't get the cut, because a Fed chair isn't a king. He's one vote in a room of people staring at inflation data. But okay, the overnight rate is one thing. That's the rate the Fed directly controls. Here's what most people never learn. That is not the rate that sets your life. Wall 2. The rate that actually matters isn't set by the Fed at all. Your 30-year mortgage, a company's long-term borrowing, and the interest the U.S. government pays on most of its debt. Those don't follow the Fed's overnight rate. They follow the bond market, specifically the yield on 10-year and 30-year Treasury bonds, and the Fed does not set those. Millions of investors around the world do every single day by choosing what price they'll pay to lend the government money. Think of it as a permanent global auction. The U.S. government shows up constantly needing to borrow. Investors decide how much interest they'll demand to hand over their cash. The president doesn't have a seat at that auction. He can't appoint the bidders, he can't fire them. And in 2026, those bidders looked at a Fed being publicly bullied into cutting rates, and they got scared. Here's why fear makes them charge more. When investors worry the Fed has lost its independence, that it might cave to political pressure and let inflation run hot, they stop trusting that their bonds will hold value. So they demand extra compensation to lend long-term. Economists call that the term premium, and in 2026 it climbed hard. The old bond market vigilantes came back. Big investors who dump treasuries the moment they smell a government trying to strong-arm its own central bank. And this is not new. Back in the 1990s, a president's own advisor watched the bond market force the White House to abandon its plans, and he said something that became legendary on Wall Street. He said, "I used to think that if there was reincarnation, I wanted to come back as the president or the pope. But now I want to come back as the bond market, because you can intimidate everybody." It was a joke with a very real point. The bond market has humbled presidents before. In 2026, it did it again. So watch what actually happened to the rates that matter, right as Trump was winning the Fed. The 30-year Treasury yield spiked to 5.26%, its highest level since 2007, 19 years. The 10-year climbed toward 4.7. The financial press stopped mincing words. One headline read, "Bond yields at a 19-year high send Warsh a credibility warning." Read that again. The market wasn't cheering the new Fed chair, it was warning him. The harder the White House pushed for cheap money, the more the bond market charged for it. Trump pressed the gas, and the thing that actually controls the rates pressed back, harder. And that is the trap, fully sprung. You can win the Fed, you cannot win the auction. So who pays for this? You do, on the two bills that hit hardest. First, your mortgage. Because the 30-year mortgage tracks that 10-year Treasury, not the Fed's overnight rate. Installing a friendly Fed chair did nothing to bring it down. As of August 2026, the 30-year fixed mortgage was still stuck around 6.7%. All that political fighting to make borrowing cheaper, and the single biggest loan of your life didn't budge. Second, and this one's bigger than most people can picture, the government's own bill. The U.S. national debt just crossed $39.8 trillion, and the interest to service it is now running about $1.2 trillion a year. That's nearly 1 out of every $5 the entire federal government spends, just on interest. Funded by taxes, yours. And here's the cruel twist that closes the loop. The entire reason Trump wanted lower rates was to shrink that interest bill. But by pressuring the Fed hard enough to spook the bond market, he pushed long-term yields up, which makes every new dollar of that debt more expensive to finance. The campaign to make the debt cheaper made it costlier. So let's go back to the fight you watched all year. Who runs the Fed? It was real, and it was loud, and it was almost beside the point. Because the Fed chair only ever controlled the short end, the overnight rate, the rates that set your mortgage, your car loan, and the government's trillion-dollar interest tab live somewhere else entirely. In a market of millions of lenders who price the one thing a politician can't manufacture, trust. That's the real answer to who runs the money. It was never the person behind the desk at the Federal Reserve. It was the auction outside the building. Trump won the desk. The auction voted anyway, and it voted to charge everyone more. The next time a politician promises to march in and force your rates down, remember what actually happened when one of them finally got the keys. The market he couldn't appoint looked at what he was doing to the one it trusted, and quietly raised the price on all of us. So if this was worth your time, take 2 seconds and subscribe. I break down a new one twice a week. Hit the like button while you're at it, and tell me in the comments, should a president have any say over the Fed at all, or is that exactly what spooked the bond market? I read every single one.